Hello everyone, this is Richard Chen with BeatOrFree.com, along in spirit with our investing partner, Mr. Warren Buffett. This is part 2 of 2 videos for the Investing Basics Overview. You should be able to find on YouTube part 1 with the same syllabus, the first half of the syllabus. In part 1 we went over points 1, why to invest, points 2, stocks and bonds, and that's actually where we stopped. So today, in this half-hour video, we're going to go over financial ratios, financial statements, and talk a little bit about growth, but basically a core investing strategy. So let's start first with financial ratios. Excuse me. So financial ratios. Okay. So first of all, to define financial ratios, they may also be known as financial metrics. I thought financial ratios would be more useful because you know exactly what they are, and it's actual ratio. So it's a fraction, as you know, if you go back to grade school and high school. And so basically there's a numerator and a denominator. And so there are different classes of financial ratios, and we want to talk about a few select examples. So financial ratios are useful because, or why are they useful? Because they give you a snapshot of a company's, you can say, financial health or financial capacity. Okay, it's kind of like going, I have some examples I want to show you, but it's kind of like going to the doctor and, doing blood pressure tests, glucose tests, that kind of thing. It provides a snapshot of your overall physical health, and that's what it does for a company. And it's done given in a numerical number, right? So it's an objective assessment. Okay, so let's talk about, there are actually at least 3 different kinds of financial ratios. The first first class is actually liquidity. It gives you an idea of how much financial resources it has to be, a company has to be able to meet its short-term and long-term obligations. Okay, so the current ratio is basically, we're gonna have to do some accounting here, and I actually and actually we'll have to define current assets and liabilities a little bit later, but actually it's within probably the next 10 minutes or so. So assets are basically what most people know as it's a future benefit to the company. So assets, obviously cash, notes payable, equipment, inventory, buildings, anything that can be actually of some benefit to the company. And obviously cash is the ultimate asset, right? So everyone knows that it's the most liquid form asset, but you can sell inventory to create cash. You can sell buildings, convert them into cash. You can convert various things into cash. So basically an asset is, I think most people know what assets are. And the liability is something that will be of a future claim on the company. So liability can be debt, it can be mortgage, it could be notes that you owe, a loan from a bank. And so basically the current ratio gives you a snapshot if you add all the company's current assets. Now current is basically any asset that you have on hand or an asset you expect to be available, or you can convert into cash in the next year. You can, you can convert to cash in the next year, okay, in the next 12 months. And then current liability is anything that's currently due or will be due in the next year as well. So it gives you an idea for the next 12 months, the next operating year, what kind of resources company has to be able to meet its liabilities. And it gives you an idea of how solvent it is. Okay, so we can come back to that later if need be. The second type and an example of a profitability ratio, it gives an idea of basically the company's day-to-day operations, whereas liquidity, it's more of a snapshot of the balance sheet and basically it's financial strength at a certain time. Profitability does address more of the income statement, and I'm giving some hint as the next section, and so looking at margin. So everyone knows, probably has, if you're in the business world, you probably have some idea of margin and how that works. What is interesting here is to talk about the three kinds of margin, how what they indication it gives you. So you have to distinguish between gross, operating, and net margin. Okay, and each of them tells you a different story. So gross margin is basically the difference between what the product or service sells and the cost of, cost or the product or service. So how much the cost, meaning how much the company paid for that product or service. So the service, it's a little, often gross is often used with, it's more convenient used with product. So let's stick with the product. Basically what the company paid for the product, differently what the company paid for the product and what the company sells the product. So everyone knows that. And the gross margin is important in the sense that it's a starting point, and also gives an idea if a company has a very strong brand. The gross margin is actually often, but not always, it can be used as an indicator of a company's brand strength. So if Coca-Cola's gross margin is 70%, in other words, it pays for every dollar Coke it sells, it pays 70 cents of sugar and water and stuff like that. And then Dr. Pepper, its gross margin is, let's say, 60%. So I'm sorry. So Coca-Cola's gross margin is 70%. It means it pays 30 cents on the for every dollar it sells, it pays 30 cents of sugar and water and other ingredients. And let's say Dr. Pepper's gross margin is 60%, which is lower. It means that Dr. Pepper pays 100 minus 60 equals 40 cents worth of sugar and water and other ingredients to sell $1 of Dr. Pepper. It means that Coca-Cola has basically selling the same product, maybe a little bit different, but they can sell the same product for $1, but make more money, more gross margin. And that's indication that Coca-Cola's, if that is the case, Coca-Cola's higher brand premium. Okay, and then operating is basically you have the gross margin, but you deduct all the cost of operation. So you pay for people who sell it, who have to file the paper, who do the paperwork behind it, who run the plants, and the cost of shipping the Coca-Cola everywhere to distributors, and basically all the operating costs of a business subtracted from that gross profit, and you get your operating margin. So obviously, as you know, gross margin, if Coca-Cola, let's say Coca-Cola's gross margin is 70%, then its operating margin would be probably less, right? Because you have to deduct all the costs. So my operating margin could be 60% or be 55%. Okay. And then net margin is basically you take all the expense. When you start with operating, you've already taken out all the business costs. Now you're looking at other costs that don't have to do with day-to-day operations. So it could be taxes, it could be interest to banks, and just other costs that don't have to. You could be amortizing patents or intangible assets, just costs that don't really have anything to do with day-to-day operations. And of course, net margin is going to be less than operating margin as well. And net margin is often what investors often pay attention to, although operating gives an idea of what the recurring margin is, and net margin often involves one-time and fluctuating costs. And so net margin basically is what happens after everything is deducted, how much profit is left after all is said and done. Operating gives you an idea of maybe it's a little bit more steady and consistent. Okay, so gross operating and net margins are profitability ratios. And then the third category is what we call valuation ratio. And it's basically an idea of the valuation, often what the market evaluates it as, and compared to maybe some objective benchmark like earnings. So the very valuation ratio, which is very popular, often, probably most used, is what we call the PE ratio, and the PE is price to earnings. And it gives you an idea of, and that's obviously price is the market price, and gives you an idea of what the market values it as, whether it's obviously it's your own task as an investor to decide whether the market is overvaluing, undervaluing, or correctly valuing it. The price is market price, or what it trades at, is going to fluctuate. The earnings, obviously, for a given day. The price will fluctuate for a given day. Earnings will not. Obviously, the company reports its earnings every quarter, right? And so, if a company has a high PE ratio, you can say it has a high valuation. And so you can see we can look at later at some reference site what the current PE ratio of the S&P 500 index is. I think it usually is historically. 95% of the time, it's been between 15 and 25, and I think it's probably a little bit, but actually it'd be interesting to check. We can look at the resources later. Okay, so we are approaching financial statements, which is very closely related to financial ratios. And first we'll introduce financial statements, and then we'll talk about how they work together, financial ratios, and I have a couple of analogies that can, non-investing analogies, to help you understand. So why and how are financial statements used, and also what are the three types? So let's first define them. We talk about, okay. So and then fill in the blank. Okay. So income statements. The first type, income statements, shows a company performance over a period of time. Well, I think that was kind of implied. So income statements show company performance over a period of time. Let's go over the three first, and we'll talk about them. And then balance sheet shows companies, and then here's the key word, assets. We talked about assets and liabilities. And during you can call it a snapshot, let's just say a moment in time, right? So literally at 10 a.m., you technically could, although you had to quote balance the books, but let's say it's 10:38 a.m. Eastern, you can look at a company's balance sheet as of 10:38 a.m. Eastern on January 31st, 2018. Okay, whereas you cannot really get an income statement at this right moment. An income statement occurs over a period, so you have to look at 3 months, when a company closes its books, what the income, or the income, the revenues, the sales, or the income over that period of time. You cannot have income over, as of 1031, right? It's accumulated over a period of time, whereas the balance sheet shows how much does the company has in assets, how much in liabilities, literally at this moment in time. Okay, it's a key differentiator. Third is cash statement of cash flows. Say cash flow statement shows where and how cash is used, earned and used. Okay, the first two are probably used more often. The third is actually often a lot of companies don't use it. Some investors use it because they want to know where their cash is, and then it's probably relevant. Certainly, the simpler a company is, the less money it borrows and that kind of thing, the cash flow statement is almost not really relevant, because the cash flow statement could be quite similar to the income statement, because you don't have debt that's paying due, you don't have, there's no discrepancy between when the money is in the bank and when we say, the sales has been booked. So, I mean, we can talk about this, becomes kind of an accounting issue. But in general, just remember that cash flow statement is kind of like that third statement, which may be useful, may not be useful. The income statement, balance sheet, actually, you should probably focus on for if you're just getting into investing. And obviously, it is important because as you advance in your journey as an investor, to really understand the cash flow statement, because it can help you spot situations where a company's taking excessive risk. Because obviously, if it has cash, and if it's a cash business, then it's certainly more financially stable than one that relies on a lot of debt, and so especially in, as you know, a downturn. So knowing a company's cash flow, where it comes from, how much, how it's used, is actually certainly a bonus as an investor. So key examples of each. Key examples of elements of income statements. And so for the first income statement, a key element of income statement is revenue and or net income. Sorry, revenue and net income. So key examples. So that's an element of an income statement. The revenue is also known as sales. Okay, and the net income, revenue is also known as sales or as the top line. It's more kind of colloquially as the top line. And then, you may have guessed, then net income is known as the bottom line. Okay, and literally that's where and why do they come from? It literally is where these elements are positioned on an income statement. Usually the first line on income statement is the revenue, and then the last line is the net income. It's basically the revenue, and you have all these deductions for expenses, and at the bottom, after you quote net them out again, then you have the net income. That's why it's called the bottom line. Very simple, right? Key example of balance sheet. The cash statement we will probably save for more advanced class. Actually, for the seminar on financial statements. So, and then the balance sheet. So again, we come back to assets and liabilities, right? So we defined it earlier. Asset is a future benefit to the company. Let's just call that benefit. It's future financial benefit. Liability is a future claim, I guess. Okay, and I'm trying to think. The simplest example is really, everyone owns a house, right? So the house itself can be not an income producing asset, but it's actually a balance sheet asset. And it has, the value of the house, or the value of the asset is whatever Zillow says, or whatever the market says, or whatever your next potential buyer will pay. I mean, there's some variation on that in terms of determining what the asset value is. But let's say your house is worth 200, 300. Let's say it's 300, right? It's a national average. So 300, according to Zillow or an appraiser. So the value of the asset, the house, is 300. The house itself is an asset worth 300,000. Okay, and then liability, as you should know, is the mortgage, right? So it could be a mortgage. Your mortgage could usually is less, but it could be more. Let's say your mortgage is 200,000, right? And we'll talk a little bit about that later. Why you need to know both of those and how they fit into the accounting equation. So the key question is, hopefully have some distinction between financial ratio and financial statements, and maybe it helps to kind of talk about them together, and so you can see how they're used together. Maybe that helps you distinguish them, because you may think that what's the difference or something like that. So we can make an analogy, let's say, with school. Everyone's gone to school, whether it's grade school, high school, university. there are two elements that are used together to assess the student's quote academic health, or how the student's academic performance, okay, or basically how well the student's doing in school, right? So financial ratios, if you use a school analogy, if you compare accounting or investing-based accounting to school, if the student is like the company, right? So the company's financial ratios are like a student's test scores, right? And again, very similar. What we mentioned, financial ratios take a snapshot. What is the company's capacity and well-being at this time, right? How well is it doing at this time? Just like a student, how well is the student's capacity? How are they doing academically? You take a test, right? And it's a snapshot on a given day, okay? And then you might have guessed, financial statements, which measure performance over a period of time, are like grades, okay? And as you know, the school uses both to assess you, right? Financial ratio is like, hey, how's the student doing? And maybe how well they could do, and the financial students actually shows how well the student performs. Oh, sorry. Test scores indicate how well the student is doing at this time, or they could potentially be doing, and the grades show them performance over a period of time. So you need both, just like a company need both. Okay, and the test score is often a specific number, just like the ratio is a specific number. Financial statements, just like grades or reports, there often can be a lot more. I mean, often there are numbers just like grades, but there are also a lot of commentary, just like financial statements. There's the actual stuff, but there's a lot of detail, but you can interpret, a lot of interpretations and details that kind of fill in between the lines. Okay. So okay, so then just to wrap things up on this financial portion is, you want to mention that this is the most important equation you'll ever need to know as an investor, and it should be, it's based in accounting, and accounting is really essential for you to know at least the portions that are relative to investing, because it's the language of business. And if you were to memorize one equation, it's quite simple. It's basically the fundamental accounting equation. And that is, if you want to remember, A minus L equals E. So assets minus liabilities equals equity. And again, if you're a homeowner, you hear that, you may hear about your house having equity. And then, again, that is pretty simple to calculate, right? So it's the market value of a house, or the appraised value of a house, minus the bank loan, the mortgage, and that's your equity in the house, right? People talk about that. And then equity there's a couple different synonyms for equity, because it sounds a little financial, right? So often, it's often referred to as book value. So we can put that in here. Book value. And this is often used for companies. Or if you're talking about individual, like person, it could actually be a net worth, right? So you ever fill out a personal financial statement? It's actually technically a balance sheet. So you have all your assets and then all your liabilities. So you own this car, this house, stocks and bonds, and then you have savings in the bank, and then you take away all your mortgage and any notes, your credit card loans, car loans, and you subtract all the liabilities, and then you have your equity, which is your net worth. Company, it's the same thing, except it's just probably a lot more items, all the assets, so all the cash on hand, the inventory, the buildings that it owns, the notes that it's going to collect, the cash that it will collect from its customers, so the accounts receivable, and then minus all the liabilities, which are basically, the mortgage on the buildings, if it owns a building, the invoices it has to pay its vendors, any loans it has to pay on the bank, all these things, and then you have the equity or the book value. Okay. So now we have a little bit over just about 5 minutes to talk about the core investing strategy, and then I'd like to go over some of those resources, which are online resources. They're first, for the part one, I showed you the books, the physical resources, and then I showed you electronic resources. Part 5, it can be really simple, or we can talk all day about it. Here we're presenting basically the core investment strategy. It just constitutes investing basics 4, and obviously this is the overview, so we provide highlights for that seminar. And let's see here. So basically, we want to do the rule of 3. So actually, investing basics actually should be investing basics 5. Excuse me, because we had stocks and bonds was 2, and then financial ratio is 3. Okay. So rule of 3: 3 dimensions of core investing strategy. If you can follow this rule of 3, I think and you know really well and focus, I think you'll have the basics to become for investing success. So first we look at strong growth. This is probably the most straightforward, although I do want to mention that you can get into some tricky areas here, especially from the perspective of value-based investing, which Mr. Buffett champions. And strong growth is, from value investing and risk-adjusted standpoint, it's really not this idea of thinking that the company has a very bright future, and you certainly have a very optimistic view of what the future looks like, and that's why this whole thing with Warren Buffett and tech stocks has been, although he recently got into that. But this idea, especially I'm not to pick on tech companies, but tech companies really paint often this rosy picture of the future, what they think will be the shifts in the way people behave and buy. Of course, that's always predictions. You can always look at what you think may happen, but again, there's always risk in that. So the key to strong growth is, will the revenues income increase predictably? And that's the correct idea. And often the companies that have these predictable volumes are often called like the boring companies, right? Because you're like, oh no, it's not sexy. It's not like, it's not like these gadgets that are going to replace all these things. And so often it's always challenging, because you think, well, it has to be strong growth. So how can it be strong growth? And if it's like predictable, so that is probably the challenge part of it. And often as value investors, you often don't try to base predictions about the future into their strong growth considerations. So you see company's growth. And it has to be based on what they see in the past, and also basically the company's business model. And of course, that's always the challenge, right? It's to predict strong growth, predict accurately strong growth. So wide moat is actually the most interesting part, and I'll talk a little bit for it. And this concept, this idea is, yes, a company can grow, but will it be able to protect its ability to generate increasing revenue? So that's a little bit different, because you're talking about, you can say the first part is like it's offense, right? And the second is it's defense, right? So, and the concept of a moat, and actually the key question is how durable, and every word here is important, how durable is the company's competitive advantage? So maybe we should define that first. So competitive advantage is this idea that a company has some this advantage allows it to make more money, and we talked about gross margin is certainly one way of objectively assessing it. Has gross margin than its competitors for selling essentially the same product. It must do something different. So it could say a company has a very charismatic CEO, it has a good brand, it has a lot of cash, could it be financial resources, it could buy better price, it has a large distribution network, that kind of thing. So that's a competitive advantage. But the question is, and that explains a company's competitive explains its current success, right? You can look at it, you can assess a company's competitive advantage, or say how effective it is by looking at its current success. Is it making more money, more revenues, or making higher gross margins? The key question is how durable, meaning how long will this competitive advantage last? If the CEO dies, if the company has unethical CEO and fritters all the company's cash, how durable is the company's competitive advantage? And that's this idea of a moat, right? And why? Because the moat is obviously, it's just something kind of intrinsic within the castle. The castle contains all the treasures, so to speak. and how wide is the moat and how durable. So often it's kind of in some ways designed benchmark, but a company's a narrow moat or a wide moat, and sometimes you hear people referring to it as narrow being 10 years and 20 years, and basically its ability to protect its competitive advantage. How long can it protect its competitive advantage, which again is its ability to make higher profits and revenues than its competitors for basically the same cost, so to speak. And we can talk on the section on core investing strategy. We can talk about different kinds of moats, and we can use some examples to illustrate. And then the key point is the right price. Okay, so it has to be able to grow consistently, predictably. It has to be able to protect its ability to grow, and it has to have the right price. Meaning that the market, what the market is valuing, it has to be this margin of safety, which you can read more about in Benjamin Graham's Intelligent Investor. I believe he said that basically it's 2/3 of its book value, although book value wasn't, or its equity, which is actually pretty low, right? And this idea is that you buy it below the margin of safety, so below 2/3 book value, and then you can basically withstand any kind of bear market, and you could still sell at some reasonable profit within your timeline or investor timeline. Okay, so we didn't get a chance to go over the resource. I probably have to do that, save that for another seminar. So we are at the 30-minute mark, and I hope you enjoyed it. This part 2 of 2, Introduction to Investing Overview.